Good afternoon, everybody, and welcome back and welcome to the final session of the day entitled Exiting Your Business. My name's Alex Peel, and along with Sue Staunton, we're joint managing partners at James Cooper Preston. Delighted to be joined for this last session by Nick Rogers, who's Head of Transactions and Corporate Finance at James Cooper, and also Phil Snell, Tax Partner with the firm. As before, if you think of a question as we go through, then do add it into the box on your screen, and that will, by magic, pop up on my screen, hopefully, and hopefully we'll leave time for some questions at the end. So if you do have anything that you want to ask, then please do add it and ask it. So as mentioned today, we're going to, or for this session, the final session of today, we're going to talk about exiting a business. We've been through much of the business life cycle today, and I think very first thing this morning we talked that the last stage was perhaps the exit process, or the sort of reinvention of the business, or perhaps the decline if none of those things happen. I think the exit process is something that many of our clients go through, but it's something they only ever intend to go through once in their business career. Some people may do it several times, but many people it is a once in a lifetime process that they go through. So I think because of that, they're often very, very keen to make sure they get it right, and quite concerned about the process. So today we're going to touch on some of the key issues in thinking about that process, and hopefully can help you start to think through that. So I think, Phil, if we can perhaps start with you. I think whilst the majority of today's session is going to consider the wider M&A market and considerations for exiting your business, one of the areas that is of a lot of interest for our clients is passing on a company with the family. And is that something that can be easily achieved from a tax perspective?
Thanks, Alex. I think it really depends, like a lot of things in tax, and the specifics of the individuals and the business involved is quite critical to that. For investment companies, it does tend to be that there are less reliefs available, such as holdover relief, for example, for capital gains tax, and therefore passing on an investment company to the next generation can be quite problematic. There are some steps that you can start to think about. So well in advance of that, you need to be thinking about options around potentially growth shares or trust arrangements. But it's something that does need to be dealt with kind of well in advance before the business does start to kind of grow significantly in value. For trading companies, the news is much better. There are good reliefs that continue to be available for capital gains tax in terms of ensuring that there's no gain when that's gifted on to the next generation. And likewise for inheritance tax, we still benefit from business property relief, so that if you've got a purely trading company, you are in a good position to be able to pass that on to the next generation effectively free of tax. The key thing to look at is around expectations after you've passed that business on. And part of the inheritance tax relief that's available can be clawed back if the business is sold soon after. So you have this 7-year window that needs to be considered. So if the aim is to pass the business on to the next generation and potentially sell the business within that 7 years, there's some pitfalls that you need to be mindful of, so that you don't end up with that inheritance tax relief being clawed back. So definitely more doable with trading companies, but definitely some pitfalls that you need to look out for.
Okay, and Nick, turning to the wider M&A market, how's the combination of Brexit and COVID affected that market?
Well, it's certainly been a very interesting 12 months from an M&A market point of view. But perhaps before I talk about specifically the impact of COVID and Brexit, and indeed the recent budget, what I thought I'd do is go back to just over 12 months ago, really pre-COVID, because at that point the M&A market was absolutely flying. Prices were very, very good indeed, and volumes of deals were probably at a record high. Why is that? Well, that's because interest rates are low, and people are looking for where they can invest their money. Corporates' balance sheets are either strong or they are able to borrow from banks. The private equity guys, the PE guys, are stuffed full of money, looking for homes. The whole nature of their business is that they have funds available for a limited period of time, and so they have to invest them. And high net worths really face a choice of some fairly low yielding bank deposits or finding a business to invest their money in. So the sum of all that meant that going back, as I said, 12 months ago, the market was really humming. Coming into the COVID period, which I guess was exactly a year ago now, for sure there was a bit of a hiatus for the second half of March, April, and into May. Inevitably, a lot of deals were put on pause. Some probably went away. We ourselves were quite fortunate we didn't see any deals go away completely, but certainly a number went on pause. And of course, in that period, there weren't any new deals coming onto the market. From, I would say, the end of May onwards, the market has recovered strongly, driven by the same factors really, that there is money looking for homes. Perhaps a lot of that money was now looking for a real bargain, but certainly they're looking for opportunities. And then we were fortunate in that, from a M&A practitioner's point of view anyway, we were fortunate along came rumours of capital gains tax changes in the budget, and there was a mad rush in the period through to that budget. So from a James Cooper Creston point of view, we were never busier than we were in that period up to I think it was March the 3rd, wasn't it? Budget day. Since then, I know Phil will come on and talk about the budget and the tax situation, but since then, yes, there's been a slowdown in new opportunities, I guess it's fair to say, but already that's starting to pick up, and there's no reason why, with the money still looking for homes, low interest rates, etc., that the M&A market shouldn't be strong moving forward. Okay,
and Phil, Nick mentioned the budget and capital gains tax changes potentially helping to drive the M&A market. Can you just sort of take us through what the potential changes we were expecting and what was announced and what we might see in the future later on this year when we have another budget?
Yeah, indeed. Yeah, I mean, like Nick says, I think it was something that there was an extremely high level of interest in the budget this time round, more so than we'd probably ever seen before, of people kind of pushing to try and get deals done in advance. And I think that was driven by a few things. Obviously, with the pandemic, there has been this knowing need for them to try and raise taxes. We see that coming through with the increase in the corporate tax rate that's been now announced for April 23. And therefore, I think there was an expectation that if they needed to raise taxes from somewhere, knowing that they couldn't necessarily go after kind of income tax and VAT and national insurance, the obvious candidate for that was going to be capital gains tax. There was also publications by bodies such as the Office for Tax Simplification that had highlighted the disparity between capital gains tax rates and income tax rates. That did point a lot of people, and that you saw it online, both in kind of forums, but also quite formal kind of like bulletins and things that got published by various people, that there was this expected change coming through. Now, the real good thing for a lot of people is that there were literally no changes for capital gains tax, even to the extent that the annual exemption, so everyone has a just over £12,000 annual exemption, was frozen and will remain the same. So in summary, I guess that the key things are there's still a 10% rate for your first 1 million of lifetime gains that qualify for what's now known as business asset disposal relief, but in old language, entrepreneurs relief. And then gains after that would be subject to tax at 20%. And I think from my perspective, these are the lowest rates of tax that most people are likely to pay in their lifetime. if you think about, the life cycle of your business, bringing that through, thinking about extracting profits by way of dividends or salary, the rates that you can achieve through capital gains tax are significantly lower than you can achieve elsewhere. So I think it's important that people acknowledge the fact that whilst rates didn't change during this budget, they're certainly the lowest they're going to be, for the foreseeable future. I think if there are going to be changes in the future, it's only going to be to increase those rates, not to reduce them, given that there is this disparity between capital gains tax rates and income tax. I mean, I think as an industry, we all need to be mindful of not crying wolf too often. Whilst Nick would love the idea that at the next budget there will be another kind of stampede of transactions that needs to take place, that the real risk that we have is that nothing changes yet again at the next budget, and we kind of wonder how many times we can go through this cycle. Having said that, if you look at the intention around budget announcements, COVID aside, where the government were trying to get to was that the autumn budget would be the main budget that would have the largest announcements. And there's key kind of understanding, or there's good logic behind that. At the moment, we have announcements that were made at the beginning of March that will become, effective from the beginning of April, for which the law has not yet been enacted. There isn't enough time between the budget and the start of the tax year for it to kind of get everything kind of organised. So you can see how they do want to use the autumn budget as the opportunity to make the bigger announcements that are then coming through for the following tax year. So I do think we need to be mindful of the fact that this will continue to be on people's radar. It feels like an easy opportunity for the government to go after in terms of raising some taxes. The only other things I guess to mention was that yesterday was the day that they released a lot of the new consultations. So there was kind of about a dozen consultations that were released. None of those mention capital gains tax, which is another real positive sign that hopefully this isn't something that will change, but do need to be mindful of what might come in the autumn.
Thanks, Phil. And so in sort of light of the environment over the last 12 months, and perhaps with sort of pressure to get deals done quickly in advance of the budget, Nick, have there been any sort of noticeable changes to pricing, deal structures as a result of all of that?
Yeah, for sure. If you go to the fundamentals of business valuations in the M&A market, they're driven by EBITDA and a multiple of EBITDA. Certainly, the impact of COVID and arguably Brexit has been to possibly reduce companies' EBITDA in the period, and certainly to add some uncertainty around that. As a seller, I'm looking to sell on forecast EBITDA. As a buyer, they're looking to buy on historic EBITDA. So there's a wider gap between the two. So what that has meant generally is, rather than a softening in price, there probably has been a little bit of softening in multiples, but generally the key impact has been an increase in earnouts. Both in terms of the quantum, but often in terms of the length of that earnout. If I'm telling a buyer that the business is going to bounce back quickly, then they're going to say, well, put your money where your mouth is, and let's put more of the consideration onto that earnout. If you hit your number next year or the year after, then for sure we're happy to pay you. But if you don't, then we shouldn't be taking that risk, or at least we should be sharing the risk. So yes, certainly an increase in the quantum or the proportion of consideration as earnout, and the length that earnout might last.
And I think that's where tax becomes quite important quite early on in the sales process, because the structure of an earnout for tax purposes is quite important. If it's structured as cash, there is a real risk that you end up with potentially a dry tax charge, particularly for those longer earnouts. If it's a short earnout, and therefore you know that by the time you file your tax return in the January after the end of the tax year that you've disposed of your business, And if you know at the point at which you're submitting your tax return what the earnout is, and you've been paid that earnout, then that's not such an issue because you've received the cash from the earnout to pay your tax bill. The risk is that those longer earnouts over a 2, 3, 4 year period that I think we have seen on a few transactions means that you're having to pay tax on the date of disposal for the value of the earnout without actually having received that, and with the uncertainty of what you might end up receiving. And from a tax perspective, there can therefore be benefits in the earnout being structured either in the form of loan notes or preference shares that allow you to potentially defer the point at which you pay the tax to the point at which those loan notes or preference shares are redeemed. And therefore, even at a simple level, having the earnout structured as loan notes that get redeemed relatively soon after the earnout has been satisfied or been paid can make a big difference in terms of the timing of your tax payments. So it's worth getting involved from a tax perspective as part of kind of looking at the heads of terms.
Okay, so turning to the exit process itself then, how far in advance do businesses need to start thinking about it? Perhaps Nick, if we start with you.
Yeah, okay, I'll pick that one up to start with. Well, what a question. The answer is as long as possible in advance of the process. Easy statement. But if you step out of the idea of selling a business and think about any asset, a house or a car or whatever, then what you do before you put the asset on the market is you get it ready. And businesses are a lot more complicated than both of those other two assets I've just quoted. So with a business, the longer you have to prepare, the better. With a house, you'd probably paint the outside, you'd clean the carpets. With a car, you'd pump up the tyres, but also you probably run the petrol down, so you're selling it with as little petrol as possible. In the context of a business, then what might that look like? Well, it would be certainly making sure all your internal administration and documentation, etc., is up to scratch, making sure that you've got KPIs measured and data to support those KPIs, a good forecasting system such that when we go out with a forecast EBITDA, there's good information and data to support that. But also going back to the fuel in the car, making sure that you manage your working capital such that you're minimising your working capital, and so you're not actually handing over a lot of assets to the buyer. There may be some surplus assets within the business. Let's have the silly example of the yacht in the Mediterranean. If you do have that, let's get that out of the business so it's not a complication in the process. So there's a whole lot of preparation that can be done in advance. Now that's the ideal world. Often that's not the case, and certainly we often go to market on the back of 2 or 3 months of prep. But again, certain things can be done in that period. There might be a damp patch in the house that you can paint over. Similarly, with a business, there might be some excess stock that we can get rid of. That sort of equivalent. So I'll come back to the point, as long as possible.
Yeah, and certainly from a tax perspective, there are things that you might want to put in place that do need a long lead time. One of the changes that came through quite recently for Entrepreneurs Relief was to extend the ownership period from 1 year to 2 years. For the founder in the business and for the significant shareholders of a business, that's unlikely to be an issue. But if you're thinking about wanting to incentivize management in the build up to an exit, and something like EMI in terms of a qualifying share option scheme is relevant and the business meets the qualifying criteria, really you want that in place at least 2 years before a sale so that you can ultimately get those people to qualify. So it's, definitely the sooner the better that you can start to have the kind of conversations. It will make a big difference.
Okay, so we need to start as soon as possible then. Nick, perhaps you can take us through the actual process, the exit process. I think you've got a slide for this. Hopefully it has appeared.
So when we take a business to market, our overall objective is to maximise the post-tax proceeds that the the shareholders, our client, receive. And I guess we look at that as there being 4 pillars to achieving that objective. First of all, we need to bring the right buyers to the table. I'll come back and talk about that. And we need to present the business to market. We come to heads of terms, and then we need to protect that value through the due diligence process. And then alongside all of that is the tax minimisation, which Phil will come on and talk about again later. So let's step to that left-hand column, or it's certainly left-hand on the way I'm looking at this slide. Hopefully the same for you guys. So the first thing is to research the market and look at who are the right buyers, who are the other businesses that have got the most to gain from buying this business, and therefore are able to put the highest bid on the table. So that's what we're looking for. How many of those people are we? How many of those businesses we're looking for? Well, each situation is different. Certainly, ideally more than one, but really we don't look to get more than probably 10 ideal buyers into the frame, because what we want to do is run a tight auction process where the businesses are basically moving ahead at the same time through this process. And if you've got too many in it, it's very difficult to control that. If you've got somewhere between 2 and 10, then you can process that, and you're thinning them out as you go until you get down to the real nitty-gritty of the auction at the end, when you might have 2 or 3 preferred, or 2 or 3 buyers in there with a view to coming to a preferred buyer. That sort of comes on to the second pillar there, the presentation of the business. So whilst we're researching the buyers, we're also preparing the information memorandum. That's the document, the particulars on the business that we take to market. It's the information which we ask the buyers to bid. It can be a very long document describing all sorts of all the aspects of the business, giving the buyer enough information to put a solid, well-constructed bid onto the table, and one on which we can rely. So it's important that we put good information into that document. Now, how long can that take? That process, it's normally at least a 6-month process, really. 2 or 3 getting ready, and then 2 or 3 into the market. Then we come to the point at which, as I mentioned earlier, we've got a preferred buyer, and we would expect them to sign heads of terms on the back of a final bid from one of those buyers. Heads of terms, letter of intent, whatever. They have various names these days. It's a non-binding document, and it's based on the assumptions that the buyer has taken from the information that we've given them to that date. And then there's a due diligence process whereby we provide much more detailed information that sat behind that information memorandum, but also broader information, all the legal documentation, customer contracts, employee terms and conditions, detailed access to the financial information, and all that is brought together within an electronic data room, which is controlled by your lawyers, and we allow the buyer to have access to that information. Clearly, during that process, most buyers are trying to pick apart the price that they've already agreed to pay, and our job is to protect that value, stop them eroding the value away from the buyers. That period of due diligence can last another 2 or 3 months. Running in parallel with the due diligence is the writing and the negotiation of the legal documents that sit around that, and then that should come through to a sensible completion. So coming back to the earlier question, really, once we say yes, we're going to market, it's normally going to take sort of 6 to 9 months, I think, to get that deal through. But those are the general processes. Think about the right buyers, prepare the information to take to market, run the auction, and then go through that due diligence process. That answer your question?
It does, thanks Nick. And you mentioned tax minimisation in there as part of the exit. I think Phil, perhaps if you can pick up on that, what are the key areas to consider?
Yeah, definitely. And I think like we said before, the key thing around that is about thinking about things early and in advance. And so Nick mentioned there part of the due diligence process. I don't know, Nick, from your perspective, but whenever I kind of get involved in transactions, as part of the DD, it always seems to be tax issues that get highlighted by third parties doing the diligence.
Yeah. Rarely is there a company with perfect tax affairs.
Yeah, exactly, and it becomes the issue that kind of gets picked up on as part of that. So one of the things that businesses can do in advance is to undertake that review themselves. So to have someone come in as a third party, do effectively a due diligence process, focusing on the key issues. And 9 times out of 10, the key issues for tax will be employment tax related issues. So issues around people not being paid through payroll, issues around how people have acquired shares. They tend to be the things that come out time and time again. And benefits is another one, I guess, in terms of making sure that benefits are identified. So doing some work in advance to try and put those issues to bed, if there are issues, can make a big difference to prevent price chipping along the way. And I think for owners, making sure that they qualify for business asset disposal relief, so entrepreneurs relief, is really important. So looking at the structure of the business, making sure that you do meet the right qualifying criteria, making sure that, like Nick mentioned, if you do have some odd assets within the business, like a yacht or some properties and things, making sure that doesn't taint the qualifying status is really important. And then there's some other just basic kind of housekeeping things. Are you making the most of things like your other half? So if you've got a spouse, making the most of their annual exemptions and their potential to access lower tax rates when it comes to disposal. It's fairly standard tax planning that couples would own a business jointly between them, and that's an accepted form of tax planning. But again, something that is good to think about well in advance. And then the final thing that I think is quite often overlooked, but when thinking about potentially providing for future generations, I think trusts do still have a place. And therefore, again, doing something in advance of a transaction to potentially put some of the value into a trust can be an option and can work out for a trading business being relatively tax efficient. So there's lots of things to look at, but the sooner the better, and being involved in that early process is really critical.
Sure. Okay, Nick, I think you said that typically I think you said 6 to 9 months was a sort of typical length for the process. Is that fairly standard, or is it possible to do it quicker than that in some circumstances?
Yeah, for sure. I think if we're running what I would describe as a full process, then 6 to 9 months is the right period, and to be honest, more 9 months than 6. So, and what I mean by that is by having that, let's say the 10 buyers in the process. But if it's if there is a shorter period that the deal has to be done in, then it can be. It just means that the auction process has to be curtailed, rather than having, as I mentioned, 10. You might be limiting it to 2 or 3 just to push it through. Does that matter? Well, the great thing about these things is you never have the benefit of hindsight. The deal is the deal, but if you only got 3 parties in the auction, then it might have been the 4th or the 5th or the 10th that would have paid a bit more. You just don't know that. But as I said, the beauty is you never have the horror of the hindsight, so you don't know.
Indeed. And just to wrap up then, perhaps, are there a couple of perhaps 2 or 3 key aspects of the process that really need to be got right, or perhaps the flip side, are there some no-nos, things definitely not to do? Nick, perhaps we come to you first on that.
Yeah, I think for me there's 2 or 3 things that people should look to do. Firstly, it's critical to have the right information that can paint the story that we're going to market with, and many SMEs that is not readily available, and so having time to prepare that information. I previously mentioned KPIs, etc. Having the KPIs to support the growth in the EBITDA that we're going to be projecting is critical. Secondly, identifying who the buyers are is an absolutely critical thing, and that can take a little while. They can often be someone from left field that you wouldn't have immediately thought of. And the third one is, don't let the process get in the way of your day-to-day business. The most important thing is to keep your business moving forward. Let us, the professionals, the advisors, deal with the process for you, allow you to concentrate on your business during the period, and just getting involved in the commercial decisions that have to be made. We don't make those decisions for you. You make those decisions, but keep the business trucking forward during that process.
Okay, thanks. And Phil, is there anything you wanted to add on to that?
I guess from a tax perspective, it's trying to have your one foot forward. I think the worst place you can find yourself is that you're, a week away from completion and they've identified something as part of diligence. You're desperate to get the deal done. They know that, and then this is where you then start to kind of leak away kind of some of the value that you've created for yourself. So you kind of getting your kind of foot in front of that, identifying the issues in advance, allows you to be on that front foot and to kind of set the agenda and to kind of drive the process much better.
Indeed, I completely agree.
Okay, thank you. I mean, I think we're at time, but we've just got one question come through. Probably got time to quickly answer that. And that is there anything in particular that a purchaser looks for in a target? We haven't mentioned the management team really yet, so perhaps stable management team is something that they're keen to see in a potential acquisition.
For sure. I don't know whether stable is necessarily the right word, but certainly good management who understand their business, understand the drivers within the business and their market position, and succession to that management. Because if our client is the shareholder, they may be wishing to exit, and it's important that we are able to present a solid succession to them within the business. Otherwise, value disappears pretty quickly, and or you get tied into a very long earn-out period because they want you, the main person in the business, to be there for that period of time.
Okay, thank you very much. That's really useful. So I think that brings us to the end of the session. So thanks to Nick, thanks to Phil, and of course, if you do have further questions or indeed want to discuss your own circumstances, then please do get in touch. Details via the website. So as I mentioned, that brings us to the end of the session, and I will shortly, hopefully, be joined by Sue Staunton to help me wrap up the day. So thanks, Nick. Thanks, Phil.
Thank you.